Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The last 6 months might have seen plenty of volatility on share markets, but it seems that investors are still opting for equities as a key part of their portfolio. However, choppy markets have caused them to adjust their approach a little. The HSBC Investor Insights survey has been released, revealing how investors have handled the last 6 months and what they plan to do in the next 6. Remember, this is general advice only, and you should seek professional advice before making any investment decisions. Donahue D'Souza is the head of investments at HSBC. Don, welcome back to Fear and Greed.
Thank you for having me.
So outside of super, equities continues to be the main attraction for investors, or so it seems. And it seems the volatility of the last 6 months hasn't resulted in them sitting on the sidelines. They're certainly still buying.
Yeah, that's right, Sean. Thank you again for having me. So out of the 1,100 Australian survey, despite the market volatility, Australian investors still looking to share and equity markets in order to continue to generate wealth. 80% of the respondents indicated that they had made investments in the last 6 months, but about 3/4 of investors acknowledged that they had changed their investment approach in the last 6 months, with about a third of them adopting a more balanced portfolio. Just under a third went more conservative, and believe it or not, there was nearly 10% that actually adopted a more aggressive stance, no doubt picking up some oversold sectors. 60% of the respondents also indicated that they were likely to further diversify their portfolio in the next 6 months. And about half of all of the respondents are considering investing outside of Australia in the next 6 months. And about the same, half of the respondents said that they'd prefer to invest in ETFs and managed funds rather than direct equities because it required less time and effort.
Okay, so it suggests people are thinking a little bit differently about investing. But I must say, I mean, if you're not a professional investor, if you're a retail investor, a mum and dad, sometimes it's actually easier to buy than sell. Would you agree?
I think the way in which investors interact with markets now, and certainly the advent of online brokerage platforms, and also the innovation in certain products, has made transactions a little bit easier. Certainly, we're seeing that investors are choosing exchange traded funds and managed funds rather than direct equities because
Yeah.
in a lot of ways it does require less time and effort. And certainly that response polled very, very strongly amongst that millennial investor segment.
Okay, so just tell me about the generational differences. What are the millennials doing that the rest of us aren't?
In most of the categories of the survey, it wasn't really statistically significant, but there are certainly a few areas to call out. For example, 80% of the respondents who said that they had monitored and tracked their investments at least once a month, that was the older investors. The younger investors basically polled that they were more likely to monitor their investments more frequently, at least weekly or daily. If we actually break that down by gender, again, men were more likely to track their investment more than once a week in that older segment. But amongst the millennial group, it was the female millennial investor who was more likely to monitor their investments daily. If we actually look at transacting and making investors, again, it was the younger Aussie investors, Gen Z and the millennials, who were more likely to invest more frequently than the older generation, although Gen X wasn't too far behind. And again, if we look at that millennial segment, again, it was the millennial female investors twice as likely as their male counterparts to make investments daily.
Wow, do you have any idea why, Don? I mean, I know you're an investment expert and markets is your expertise, but shift into psychology just for a moment. I wonder why that's the case.
Well, I think millennial female investors, perhaps, I mean, this also got brought out in another segment of the survey, just in terms of the availability of education and also knowledge transfer, I guess, from the older generation. But it's also where they get their information sources. So I think one of the alarming statistics is that the number of respondents that have relied on social media to get their information.
Tell me about that. I'm scared of this one.
Yeah, so interesting part of that survey is certainly, look, I mean, I do acknowledge that the way in which investors and consumers as a whole engage with financial institutions and the organizations, obviously the financial institutions and organizations have had to evolve too, to make sure that they're well placed in social media. But there is a lot of information out there. I do find that the information on social media is a lot more condensed, bite-sized. You've even got indicators to tell you how long the read is going to take.
Mm.
And look, we are all time poor. Social media posts manage this well, and there's always options there to read the larger report. However, it's really important for investors, if they're sifting through social media, that they are turning to credible and trusted sources. Most of the banks, even governments and financial planners, advisors, fund managers, they all have a social media presence. So it's important to
Yeah.
go to the more trusted sites.
Yeah, and this is a good time to remind listeners, you need to seek professional advice. Don is an expert, but when you are investing, it is your own money. It's stuff you've worked for, and it really is important, would you agree, Don, to get professional advice?
Oh, absolutely, particularly in the current prevailing conditions. So, yes, we've talked a lot of stats. We've talked a lot about what the different generations are doing and what different genders are doing. We've also talked that, there was a strong interest in looking at offshore equities and also looking at ETFs and managed funds. But even that, it comes right back down to your investment plan. So make sure that the investments you choose are fit for purpose, that is, that they meet your objectives and financial needs, that they fit into your risk tolerance, and where possible, if you're not sure, please seek professional financial advice.
Stay with me, Don. We'll be back in a minute. I'm speaking to Donahue D'Souza, Head of Investments at HSBC. So we've talked a little bit here about ETFs and managed funds, and certainly from my point of view, when I'm not actively managing my portfolio, I like those sorts of things because I'm getting an expert to do it for me effectively. What about international shares? So you said people wanted to buy international shares. Do they tend to be the big high profile, the Apples, the Teslas, the Microsofts of the world?
Well, certainly that there is an attraction and some prestige of saying that you own equity in those companies. But the interesting part of this finding was that even though a strong population had indicated, over 50% of respondents, that they were looking to invest outside of Australia, about half of those respondents actually didn't know or were unsure on how to invest outside of Australia. Now, again, if we break that down by gender, fairly or unfairly, female investors polled higher, that they were unsure than their male counterparts. And again, if we break that down by generation, again, it was the millennials leading the way who had the most idea of how to invest overseas. And what it points out to is certainly there's a lot more work that needs to be done by the industry as a whole as far as education is concerned. And as I mentioned before, investing overseas may not be right for you. It might not fit into your financial needs and objectives and risk profile. And I think the dislocation might be that some investors think that they need to invest directly overseas, but they can actually access all of those sectors, geographies, and industries with active and passive funds that are listed here on the Australian exchanges.
Okay, so if we were going to come down for 2 or 3 rules for an investor, so my son, for example, has just started investing. He kind of tries to put $500 a month into an equity. He's very young, and the whole idea is that he thinks about it, and it's not huge amounts of money. I appreciate that, but at the age of 20, doing that once a month is probably not a bad habit to get into. What it's about having a plan first.
Yeah, that's a great summary, Sean. So it is about having a plan, identifying what the end objective is, identifying the investment horizon, and then how much risk you're prepared to take between now and the end of the time horizon. Now, obviously, your son, very young, very long investment time frame, so he could probably adopt a more aggressive approach, and perhaps because he's got such a long investment horizon, can probably ride out all of that volatility. Now, it's interesting that you mentioned that investors now, similar to your son, because of the market volatility, they're avoiding the all-in approach, right? So what
Yeah.
they're doing is they're putting in a small amount initially and then gradually investing small amounts over time, almost like dollar cost averaging. And obviously, in periods where there's a massive sell-off, they might go a little bit harder to top up their units. So dropping in small investment amounts, particularly in this volatile period, and averaging down your price might seem like a good idea at the time.
One final question. What do you think? This is kind of going back to the whole concept of social media and millennials getting involved, the idea of influencers and whether regulators are going to get more involved, do you think, on somehow managing the market so that consumers don't make mistakes? Inevitably they will, but at least somehow trying to have some parameters around those mistakes.
Yeah, certainly. I think it's a good thing. It's a little bit of the Wild West out there in terms of social media land. And that's, I come back to my earlier point. Yes, we are all time poor. And yes, there's a lot of social media. It can get quite noisy. And trying to cut through all of that to find through trusted sources is of incredible importance. Otherwise, you do get drowned out. You do have that analysis paralysis type of mantra, and you don't know what the underlying motives of some of the influencers are. So I'm glad that there is attention that's being paid to some of the rogue posts and finfluencers.
Don, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Donahue D'Souza, Head of Investments at HSBC. This is a Fear and Greed daily interview. Remember, as we mentioned a moment ago, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.